Everyone, welcome back to the channel, your number one source for income-oriented investing. And today I want to talk about a subject that really gets me on my nerves, but I'm going to have to keep talking about it, I guess, because I still see it prevalent in YouTube comments and places on the internet, etc., etc. It's about NAV erosion. So I made a few videos on this already, but I want to focus a little bit more on QDTE today, the Roundhill Nasdaq 100 covered call ETF. And we're going to do a deep dive into this one, QDT in particular, because I think it's a perfect example that actually proves that this whole premise of NAV erosion is a myth. It's pure nonsense, and I'll prove it to you. I've gotten comments. As you guys know, I've went pretty much all into QDT for our retirement accounts, and I still see some YouTube comments talking about NAV erosion relating to QDTE, and the NAV erosion should not even be mentioned in the same sentence as QDTE. It really gets me on my nerves, and I'll try to show you why right now. So QDTE, just to refresh your memory real quick, is the Roundhill Innovation 100 Zero DT covered call strategy ETF. It's basically a NASDAQ 100 covered call ETF strategy, everyone. And it gives you weekly distributions. It has a pretty high expense ratio at 95 basis points. That's because they're doing daily calls. So it costs more work, or takes more work to run this strategy. And you see all the distributions, the weekly distributions here that are paid. This ETF has been out since came out in March of 2024. So a very interesting information has been released by Roundhill. I absolutely love this graph, or this graphic. It makes me laugh every single time I look at it. You see the total return performance, the total performance since the ETF was created until the end of September. You could actually see that QDTE, not only is it beating its other NASDAQ 100 covered call competition like QQQI from NEOS, QILD from Global X, QQQY from Defiance, also other ones I didn't add, but it's also beating the very popular passive index fund QQQ, the pure NASDAQ 100 exposure, right? So how is it possible that people still think or see QDTE is having NAV erosion when it's actually beating QQQ? It makes absolutely no sense. If you look at the stock price, let's look at the stock price of QDT. You see that it started at 46.44, but now it's 43.29. Just for reference, I'm filming this on November 14th while the market is still live. So you might be saying, Adrian, of course there's erosion. It started at 46. It's minus $3.27, or down 7%, right, from 46 to 43. While if you look at QQQ in the last year, it's up $125. It's up 32%. That is not the right way of looking at it, everyone, because these are stock charts and they don't include all the distributions that the funds give. This is why when you look at this picture, QDT is beating QQQ. You will never see that or realize that if you're looking at the stock charts. To realize that, you have to look at the truth. This is why I put this in the title. The ultimate truth is always the total return, aka performance, aka total return performance. You actually put it all in one sentence here, which I like. Performance, total return. It's all the same thing. This measures the value of your investment, which is the most important thing. You could even use another tool where it literally compares two funds. If we compare QDTE versus QQQ, and if we put a date of 1995, which means it's just going to select the date of when QDTE first came out, which is March 7th, until today's date, or yesterday's date, November 13th. And it's basically simulating, if you're going to put 10 grand in each on the exact same day, how much is your investment worth now? You'll see that your QDTE investment, and this is if you're reinvesting if you're reinvesting all the dividends, your 10,000 would turn into 11,857, with QDTE, and QQQ is lower. Your 10,000 will be 11,549. So you see that the total return, the ultimate truth, everyone, 18.57 with QDTE, 15.49 with QQQ. And by the way, even if you're not reinvesting the dividends, because when you're reinvesting your dividends, there is a little compounding effect going on, of course, right? But let's say you're not even reinvesting the dividends, QDTE is still ahead of QQQ. So if you're just taking all your QDTE dividends, you're spending them, you're investing it in something else, whatever, your QDTE investment, $10,000 investment, is still beating QQQ. Look at it. It's right here. 10,000 to 10,569, 10,000 to 11,545, or 10 to 11. Anyway, I think I mispronounced it, but whatever. You see what I'm talking about, right? So this is why, everyone, you cannot judge. You cannot look at just the stock prices. It's completely ludicrous to me. It's absolutely bananas. I don't know why people are looking only at stock prices to gauge the value of an investment or the performance of an investment. You have to look at the actual performance, the total return, and you could easily do it using these tools. This is the ultimate truth. This includes the dividends. Another way I could explain it is, how do you gauge an ETF that has a lot of dividends as high yield looking at the stock price? Because if you're just looking at this 46 to 43, and that's minus a 3.27, right? So that seems like NAV erosion, but it's not. You have to do 46.44 minus 43.29 plus all the dividends, plus 0.25, 0.26, 0.20, 0.20, 0.31, 0.26, all the dividends. This came out, all these weekly dividends that QDT pumps out, that comes out of the net asset value. It comes out of the stock price. So it should be 43. If QDT, for example, did not give out any income every week, they just reinvested those covered call premiums into the fund itself, the stock price would be 43.17 plus all the distributions, boom, 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 all of them, right? So of course it would be probably closer to $50 or something, or $52 or whatever it is. You could add it up and the stock chart will look much different. This is why I'm telling you, I tell people, I say it all the time, stop looking at stock charts to gauge performance. Please, I'm begging you, look at the total returns. Look at the returns. It's very, very simple, guys. I mean, it's crazy that a covered call ETF without leverage is beating the index itself. That's probably another story for another video. But again, if you think that QDTE has NAV erosion, there is something wrong with you. I'm telling you. I'm sorry. I'm not trying to offend anyone, but I really feel strongly about this because it could make people not invest in a really, really great fund. And I'll give you the example of my personal investment. So I personally invested approximately $180,000 into QDTE a while ago, and I have it on DRIP. The value of my investment, this is with the DRIP, is now $215,000. I put in 180, and now it's worth 215. Does that seem like NAV erosion to you, everyone? Of course not. It makes absolutely no sense. But if you look at, for example, my P&L, my profits and losses, you'll see I'm only up $12.49. That's because the broker does not count the DRIP as part of the investment. So this is why I completely ignore the open P&L, because it's not the entire story. And multiple brokers will show you that you're probably not doing as well than you are. So I ignore this. Focus on this. Focus on the value of your investment, because that's what we're investing for. We're investing to grow the value of our investments, right? So 180 is now 215. So it doesn't say that means I'm up $35,000. My P&L should be plus $35,000, but it doesn't show that way. It doesn't show that here because it's taking the drip, it's not calculating that as part of the investment. So another way to explain it is every time that weekly dividend goes through, it's minusing that from the P&L. It's basically including every weekly dividend as a loss is another way I could explain. Hopefully that makes sense. But I just want to make sure you guys are aware that this NAV erosion crap is a pure myth, and that goes for everything that has a positive return. QQQ, QDTE, QQQI, QYLD, QQQY, none of them have NAV erosion because it's a positive. The return is positive, right? It's positive. The only way NAV erosion could exist is if the return was negative. Then I would agree with you, right? So again, stop looking at the stock charts only. Look at the total returns. An analogy I could give you is if you own an apartment building and you sell it after 10 years and you for 10% higher than what you've bought it for, well, your total return is not 10%. It's 10%, right? It's the profit of the sale plus all the rents that you've accumulated over the years, minus all your expenses, taxes, repairs, fees, etc., etc., etc. So the total return, everyone, the total return is what is important here. And this is why NAV erosion is an absolutely stupid myth. That if you want to be an income investor, you have to understand this. If not, you're going to be in trouble. So hopefully this video was informative for you. I've tried to give you my own personal take on this. The example using my own investment in QDTE. There's not much else I could say about this. It just drives me crazy when I see people talk about QDTE and talk about NAV erosion when it's actually outperforming the index itself. So again, everyone, look at total returns instead. Use this tool. It's a free tool where you can compare any ETF. So you could compare any NASDAQ 100 covered call ETF to QQQ, any S&P 500 covered call ETF to IVV or VOO. There's one for Canada. There's one for US. I'll put the link to this in the video description below. So give me a thumbs up. I would really appreciate it if this video was informative for you. Let me know your thoughts and see you next time.